Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. My name is NUR ATIKAH BINTI ISMAIL. I'm from BA242 4B. Today, I want to discuss and share about the differences between conventional and Islamic financial system. Before we start, let me see about what is definitions of Islamic financial system and conventional. Islamic finance is banking or financial activity that comply with Sharia or Islamic law, which means excluding the prohibited riba, ghar, and maisir. Its practically application through the development of Islamic economic. Some of the modes of Islamic finance including mudarabah, wadiyah, musharakah, murabahah, and ijarah. Islamic finance profits is halal and not known as a riba because the profits is based on value of risk, effort, and liability. Conventional financing is a home financing scheme offered by financial institutions or banks, which are not guaranteed by government agency. Conventional loans are given as per guidelines issued by government-sponsored entities. This ensures that such loans can be sold in the secondary market. These institutions are limited to the monetary affairs and to the monetary market, which are proposed to gain monetary benefits in right and wrongly. Before I start the discussions, I want to focus about the three terms that show the difference between conventional and Islamic financial system, which are value propositions, operational mechanism, and instrument offered. The first different term is value propositions. Value proposition is a promise of value to be delivered, communicated, and acknowledgement. It is also a belief from the customer about how value will be delivered, experienced, and acquired. It is like part of a company's overall marketing strategy. The advantage of Islamic financial system. Firstly, business framework. The Islamic financial system is the function and operating modes that are based on Sharia law. Banks have to ensure that all business activities are in compliance with Sharia requirements. But for a conventional financial system, the functions and operating modes are only based on secular principles and not based on any religious law or guidelines. Secondly, for the advantage of Islamic finance, there have no provisions to charge any extra money from the defaulter, but for conventional finance, it can charge additional money in case of defaulter. Operational mechanisms can be defined as the means of control over the pace and directions of an entity. Other than that, this is simplest and tough still critical of the element. The first one is interest rate. For Islamic finance, prohibitions of interest and usury in financial dealing. It is because under Islamic financial system, money is mere a medium of exchange and not a factor of production independently. However, for conventional finance, it allows of interest and usury in financial dealing because under conventional financial system, money is mere an asset and it is a factor of productions independently. Second is allowance for investing in bond industry sector. For Islamic finance, activities such as dance club, conventional banking, insurance are unlawful. Hence, earning return through investment in any of these activities is not allowed under Islamic financial system. However, for conventional finance activity like that is hence earning return through investment in any of these activity is allowed under conventional financial system. Secondly, in Islamic finance, financing for only halal business, while conventional finance financing for all of businesses. Next is Sharia Supervisory Board. For Islamic finance, each bank should have a Sharia Supervisory Board to ensure that all business activities are in line with Sharia requirements. However, for conventional finance, there is no such requirement necessary. The last one is instrument offer. Both of my banks which are conventional and Islamic are offered same transaction, but those instruments had a different name and characteristic. For example, the transaction that made by conventional and Islamic finance is trading, participating, and supporting. Deposit or liabilities. For Islamic banking, Islamic bank offer deposit product based on the following structure, which are card and mudarabah. For current account are offered under this contract where the risk of the funds lie with the bank and no added benefits are provided to the client solely based on this facility. However, the clients may be allowed to avoid those facilities which are offered across the board. For mudarabah, a type of partnership where client funds are invested in various business and returns are shared between the bank and client as per the agreed profit sharing ratio, whereas the loss is shared as per the investment ratio. Term deposit and savings account are offered on the basis of mudarabah. For conventional banking, conventional bank accept deposit on the basis on loan of all type of deposit account, including term deposits, savings, and current account. Interest-based return are provided for the saving account and term deposit, whereas current account may offer free banking facilities. In addition to this, conventional bank invest the deposit in on Sharia compliant avenues and subsequently learn non-Sharia compliance return. Overdraft or credit card. For Islamic banking, under mudarabah, only profit is due when the commodity is delivered to the customer. Compared to conventional banking, under conventional banking, a customer is charged with interest once the facility avoided. As a conclusion, the discussions show a growth of the Islamic banking industry as the Islamic bank in our study is showing better performance than the conventional bank in the later years. Thank you.